Good morning, folks. Welcome to the Sense of Things. It's Jeff and Ron here once again, and we are kicking off another week. This week was an interesting week, I think, from an economic perspective, and a lot of things going on there. We have a very unique Florida man story that I'd been holding over the last couple of weeks. So we will cover that a little bit, and then Ron's got some stuff on really long-term investing today. Ron, how you doing, bud?
Good, Jeff. Yep. No, as we always say, never a dull moment, especially with tax season winding up earnings, which has been interesting. Good news is bad news is good news, and guidance. But it seems like there's a lot of beats, but a lot of beats based on revised down guidance from
Yeah.
revised down guidance. So we'll have to see how things pan out Q1, but perhaps we'll see a little bit of moderation at this point.
Yeah. Yeah, it was interesting because I monitor briefing.com, and I've got a workspace that I built on there where it has like economic data, and then it's got an earnings, just literally it's an earnings sleeve that just watches earnings as it comes through. And it was interesting over the last couple of weeks watching the earnings. I guess the thing that I will say is beyond the big household name companies, there is a lot of earnings revisions upward on some of those, what I would consider that second tier of companies, where they're reporting and they had a beat, and then they're actually reporting, hey, we're probably going to have a better 2024 than we had 2023.
And a lot of those have low debt.
Yeah.
Again, the ones that are leveraged that are struggling with profitability are going to be SOL in the next 6 to 12 months.
Mm-hmm. Yeah, no, totally agree. Well, let's kick off.
Yes,
I have a
always
Florida
Florida man
man.
story.
Cannot wait to give this Florida man story. It was awesome. Let me just cue it up here. So we have our Florida man.
Oh yeah.
This is an imported Florida man on top of it. So I think this was the good part. I was watching this on a TV show or on a news show, and they were talking about this guy, and I had to go in and do a little research. Apparently, Florida now is importing Florida men, and this gentleman is from New York. I believe he claimed asylum and went into Florida, but apparently, what happened was they were having some high waves and surf and all that, so they had closed the beach. The big sign says no trespassing, do not come in, and he decided that he was going to drive on the beach. They ended up having to go in and rescue him, and this is the greatest thing ever. His response was, not my fault, the truck don't surf.
Gotcha. Well,
So
it looks like he had a good night's rest.
apparently, of course, he whacked his head pretty good, apparently, in the process, driving his truck out onto the beach. But
These are the
I
people that
felt
live
like
among.
we had to share this Florida man import now. So they didn't have enough Florida man stories. They needed to import some folks from out of state to improve the Florida man stories for all of us.
Unbelievable. Look, it shouldn't surprise either one of us. But the sad thing is, this person's been living among us for how many years?
He's probably in his mid 50s or so. So it's amazing that he hasn't been a Florida man story before this time.
Oh my goodness. All right. So I got a couple of fun things. We could do one of these every week, but you
Yeah.
like to look at this because when you're running a business, are you making the right decision, the wrong decision just over time? It's just you want to make a hell of a lot more right decisions than wrong decisions.
Mm.
So I chopped this down a little bit on some of the details, but 1962, Decca Records fails to see the talent and potential in a band. And why did they reject the band? There were two main executives. One of the executives said, guitar groups are on the way out. Which band was that?
No clue.
Come on, figure it out. How to be those?
The Beatles.
Because the guitar groups are on their way out.
They're on
Yeah,
their way out.
yeah.
Yeah.
Because clarinets and big cellos are the way of the future. Now, I also heard a story too. I don't know if you remember Jack Kent Cooke. Okay. Jack
Okay.
Kent Cooke, who was born in Canada, loves hockey and buys the right to an expansion team in Los Angeles. His
Okay.
research had determined that there were 300,000 Canadians living within a 3-hour drive from the arena. But he
Okay.
did have some initial problems. The team and ticket sales were very sluggish for many years and couldn't figure out why people weren't coming out to see the team.
Yeah.
So he was digging into it a little bit, and this is what he figured out. After further consideration, he stated the reason why Canadians weren't showing up for his team. Now I know why they left Canada. They hate hockey.
They hate hockey. That is awesome.
Yeah, they hate hockey. So
you had to import Wayne Gretzky to actually make people excited about hockey in
but he had
LA.
already sold the team by then. The funny thing, and he sold it to another crook, Bruce McNall. But rather ironically, there is a tie here with the Beatles. There's a story / rumor, but I've seen it in a few different places, that when the Beatles were getting popular and they were starting to get more global, they needed a distributor because it was Apple Records in the UK.
Yeah.
They needed a distributor in the US. Jack Kent Cooke was offered to do it.
God.
He didn't like rock and roll music, so Capitol Records took that contract on.
Yes.
Yeah. Bad decision, schmuck number 2.
But schmuck twice over. I believe he liked the cello music coming from Decca Records, so it was,
don't forget the clarinet solos.
Yeah, that's true. Yeah, clarinet solos.
Harry James is making a comeback.
Maybe a little bit of Dixieland jazz, 1920s Dixieland jazz too on top of it. So yeah,
of course,
those are the more enjoyable.
Well, all right, I'll let you go through your economic stuff.
Let's take a look here at economics because it was an interesting week. I've been calling this the tale of two cities this week. We had earlier in the week, and I'll go to that first, core CPI. It was interesting because the expectation had been 0.2 and January CPI came in at 0.3, and it was a real kind of a shock to the market. It doesn't seem like a big difference, but in the case of CPI, it's a really big difference and a dramatic difference. And it was funny because Ron and I have been talking for literally months on end about everybody saying, oh, in March, the Fed's going to start lowering interest rates and all that. And this was like the shock to the system that maybe not. There's no real reason. And in fact, the core CPI is actually moving the opposite direction. It headed back up to 3.9% on the year-over-year basis. It's not moving in the direction that the Fed would want it to be able to say, hey, we're going to start putting the brakes on a little bit. And I think what it did more than anything from my perspective is it just told the story of how little control the Fed has on inflation right now because the government keeps plowing money into the markets and keeps spending and spending. And it's counteracting any of these interest rate raises. What's your thought on that, Ron?
Look, the key spending that they have been doing is in infrastructure, and that's not going away over the next 10 years. I mean, for the last administration, current administration, we all know, and I see it around me. I don't know about by you, a lot of paving of the roads and still some potholes they got to fix, but there's still, even on the highways, they're resurfacing highways. So all that is going on. Really what it comes down to in the spin from the current administration, which is what they have to do, is inflation's coming down. Okay, but specifically what? I don't know about you, and I think we may have brought this up. Try and go for a lunch at a restaurant, a burger, whatever, and spend less than 15 or 20 bucks. Breakfast is $8 to $10, no matter where you're going, if you're lucky. Dinner, forget about a steak dinner, lobster dinner, whatever. Just even a spaghetti dinner will cost you 25, 30 bucks a head. So
it
was going up before COVID.
Yeah.
But now it's just gotten to the point where these restaurants say food costs are just too darn high. We can't make any money unless we charge this. I saw somebody say, why do you charge $16 for a bacon, lettuce, and tomato sandwich? It's bread, it's lettuce, it's a couple of slices of bacon and tomato. Do you understand what our costs are? My overhead every month, or my rent every month, is $20,000. My response to him is, if you're selling bacon and lettuce and big BLT sandwiches and your rent's $20,000 a month, I think it's time for you to move.
Yeah, no kidding. You need to find another building at that point. And the challenge is rents are through the roof.
Or a hot dog cart to sell them out of.
Yeah. And I think that was the big part of the CPI number. If you really dug into it a lot, it was food cost, it was housing cost is through the roof. It has continued to just go up and up. And that's not only the physical cost of housing, but all the related pieces of it. Insurance costs are going through the roof. All the other components of that are going through the roof. I don't see that coming down anytime soon. We certainly are in a more volatile time as far as weather goes, whether or not that's global, whatever you call it, cooling, warming, change, I don't care. Whatever you call that, we're in a more volatile weather period right now. I don't think that's a surprise to anybody. And that's having a pronounced effect on the insurance costs and everything else. And that ain't going to come down anytime soon. The fact that we have wildly underbuilt, especially in the lower end of the market. I went to a due diligence meeting with a real estate fund that I work with clients, and they were talking about just how wildly we've underbuilt in what would be considered the starter home area of the market. For the last multitude of years, these home builders have been building $500,000, $600,000, $700,000 houses when they should be building a couple $100,000 houses. They just don't want to build them.
Money on them.
Yeah, they don't make as much money. There's in a lot of cases in towns like mine, there's limited amount of land, so they're going to put the most expensive thing on the land that they can get their hands on.
Yeah. Look, the greatest input cost you typically in a business is what? Labor.
Yeah.
So to just see what's going on with labor cost and wages and everything else, I think I saw some stat in the last week that wage costs or wage increases have finally surpassed in inflation, meaning that wages are now trending ahead of inflation. But even so, what it's going to come down to at this pace, you're going to pay $10 to $15 for a Big Mac in the next few years.
Yeah. And then I saw some person running for Congress, I think, out in California, that was recommending that we go to a $50 minimum wage in California.
I heard that yesterday. That's not going to happen.
I was like, okay.
No, if that's the case, go off the grid, do what you need to do in your town.
Yeah, because it's just
actually, I think it was San Francisco or Northern California.
Yeah, that's you need to have a $45 Big Mac in those areas. So
they have at it if you got it.
Yeah. Tale of Two Cities today, core retail sales, and this is a chart through December of core retail sales. They've been holding up throughout that time period, and today retail sales negative 0.8%. The estimate had been negative 1 or 0.1%. So a big change.
Better than expected.
Worse than expected at this point. Dramatically worse than expected.
If it's negative, it's not as bad.
Well,
it's 0.2% better than the estimate. Not that saying a lot.
Yeah. No, actually it was negative 0.7 or negative 0.7 difference versus the estimate. So yeah, it was way worse than was expected. So it's interesting to see that dramatic change. Now that can be a volatile number and it can change, and you really want to look at it more on a quarterly basis. It was interesting to say, wow, a big difference. I think the last thing that this one didn't get a lot of press today. I always monitor the press and hear what the talking heads are talking about. This one really didn't catch the news wire as much. It typically is considered a low market factor by briefing.com, but it was interesting to see industrial production came in at negative 0.1 and the estimate had been positive 0.3. So another one, and this is in the manufacturing production sector, a big tail off. When it's been on the decline for the last several months, it spiked up during 2021, and it's just been on a gradual decline. And this just puts it back another in the negative at this point. And I believe it went negative and then popped back up, and it's heading back to the negative side again. And this is something that we've seen not only in this big picture number, industrial production, but we've seen this from the various feds. Their manufacturing indexes have been negative pretty much for the last year and a half.
I will tell you, we're not going to, obviously, we're not going to get into it, but I thought it was interesting. We've talked about the PMI number, which is the
Yep.
manufacturing number, and anything above 50 is positive, anything below 50 is negative. It was negative the last 3 months. It
Mhm.
went above 50 this past month. So think about it.
Yeah.
Production and capacity, most of that is in manufacturing.
Yep.
So how did PMI go up and
Production go
capacity go
down. Yeah.
down?
Yeah, it's one of those things. It's that initial thing where I start to go, it's interesting. We still need to continue to look at it, but I once again, we've seen it on a pretty much a consistent decline after that big spike up. We had that spike down during 2020 with COVID, and then the huge spike up, but it's just been wandering its way down into the negative. And the last thing I wanted to cover, this actually just came off literally an hour ago off of the news wires, and this I caught this off of NASDAQ from a Zacks investment article. Total Q4 earnings for 369 of the S&P 500 that have reported are up 5% or 5.8% from the same period last year, and 3% higher. So earnings were up 0.5% or 5.8%, revenues up 3.6%, with 79.1% beating earnings per share estimates, 64.8% beating revenue estimates. And I think to Ron's point before, off of, I think a lot of these companies had been pulling those numbers down, pulling the estimates down so that they could blow out and have a blowout numbers.
Yeah, I look, the one thing that this doesn't have, and I've seen different numbers, is what is the specific number of those earnings and revenue, top and bottom line? What percentage of that is the tech sector responsible?
Yeah.
I've heard as high as 50 to 70%.
It's that the
One
last
sector.
sentence. Yeah. The last sentence. The tech sector is solely responsible for keeping the Q4 earnings growth
Right.
pace in positive territory.
I would just look at what percentage of that,
Yeah.
but obviously this is the majority. So more than 50, obviously. Look, we always say, how long can this continue? The nice thing about the tech, right? What's their biggest input cost? We all know it's labor because
Yeah.
it's not manufacturing, right? They got a lot of remote work and whatever. Maybe I know there is some manufacturing there with the hardware components and routers and whatever, but even they still have the highest revenue per employee and earnings per employee, and there's a reason for that. That's where the growth is. It's not in fintech, financial technology. It's not in healthcare necessarily,
Yeah.
because they keep raising healthcare costs, but they're getting the same amount of people that they're serving. So, we can keep going, we can keep digging down to that.
Yeah.
But, again, the tech sector, how, is it FOMO? People going to keep putting money into the tech sector to keep it rolling? Or is it passive investing where set it and forget it, blindly just let it go? It should be interesting to see. Some of these charts are looking a little ridiculous, to say the least.
Yeah, it is. And you're also seeing, I think the biggest thing I saw on Monday right now, it's the tech sector, but it's also the tech sector that is putting anything into AI. So they've got to start talking. They have to talk about AI on every call. Otherwise, they just get no bump as far as anything that's going on. And the other part that I've seen, though, the biggest ones that got hit hard on Monday or on Tuesday when the CPI number came out are some of the high flyers in the AI space. So I think that's starting to get frothier and frothier because people are just assuming that because they're doing things with AI, these stocks are going to go up like rocket ships. And some of them are just very unprofitable at this point. They're not earning anything from it.
No, I agree. All right, let's get into a little bit of long-term investing. This is always good fodder. Unfortunately, we only have about less than 10 minutes to go through some of this, but you know what? Every chart, we always say this, every chart tells a story. So this is from our friends at First Trust. They always put together some good things. And I thought was interesting, if you look at it, over history, there's always been a recession every 6 to 8 years, just a typical economic cycle, the binge and purge of credit. So if you want to think about it, why after 1981 did the recession spread out more so than prior to 1980?
Mm.
So I got a theory. I want to hear yours.
Yeah.
Remember, prior to 1981, right, it was only pensions for retirement. After 19, because it was originally initiated 78, the 401k section,
Mm.
it didn't gain a little bit of traction, but it was only in large corporations in the 80s.
Yeah.
So
Yep.
this is really where it started to gain traction. What happened in the early 90s? ETFs were introduced. So between 401ks and between ETFs, which now ETFs, if they're not as big, they're bigger than mutual funds right now.
Oh, yeah.
It's been much more passive investing.
Mm-hmm.
So people are like, oh, I got all, where's the majority of a lot of people's wealth? It's in their house or it's in their retirement plan. If they're not over 59 and a half, they can't take their money out in an in-service distribution. So it's passive. Set it and forget it. Let
Mm-hmm.
it stay in there. So they're not selling, obviously, individual stocks in their 401ks. And if they roll their money over, yes, they could pick individual stocks, but a lot of people are just invested in a lot of ETFs, spread
Yep.
out the risk. So all this passive investing, yes, we got the computerized investing, which is 72% of the volume in the market. But overall, the average investor is just in funds,
Mm-hmm.
passive investing. So with a lot of what we've seen going on, despite all the crappy economic numbers and which way they're trending, people can't get in and out of stocks like they did before,
Mm-hmm.
if they're in funds and ETFs. What are your thoughts on this kind of boom and bust and bull and bear market?
I think you're absolutely right on that. It's where you've got, and I wouldn't say just passive investing. I would just say institutional investing. More and more people are just saying, okay, I'm going to follow the institutions, and I'm going to buy index, or I'm going to buy ETFs, which a vast majority of ETFs are somewhat index based. It's going to follow whatever index it's following. The costs are extraordinarily low. I think both of us use ETFs as a core of most of our portfolios. I do
100%.
some individual securities, and I do some individual credit securities inside of my portfolios. But the core is mostly ETFs, because I want to be able to spread the risk out without me having to go in there and pick what stocks are going to be the best ones out of a big index or something like that. It's just very difficult to do. Like I said, there are a few things that I use to enhance a portfolio with individual securities.
Yeah. So we got the, so this is a bit of a
Yeah.
recent history, 80 years or so. But here's the other thing too, talking about long-term investing. If you missed
Mm-hmm.
a certain amount of best days, so if you missed all the days, or no, I'm sorry, if you were invested all the days,
Yep.
if you invested $10,000 in 79, so in the last 44 years, essentially, you would be, if that 10,000 would have grown to 1.366 million.
Mm-hmm.
If you would have missed the best 5 days, you would have been over $500,000 less. Missing the best 10 days, 700,000, and so on and so forth. So yes, we've seen some major escalator up, elevator
Mm-hmm.
down. But if you just kept consistent contributions and never got out of your high quality positions over the long term, it's going to work out for you.
Yeah, and it's funny. I just got a copy of the Dalbar report, the 2023 Dalbar report, which, for those of you that don't know what that is, Dalbar since 1993 has done this study of individual investors. So basically, the individual investor, the average return that an individual investor saw, and it was very interesting. It actually was better than the previous report, but it's still ridiculous that the average investor, the S&P 500 over that time period, is up close to 10%. The average investor 6.2%.
Yeah.
And people would say that doesn't seem like that much. When you start to think of that over time, that's 4%, or just a little under 4%, little 3% less. When you start expanding that out over 10, 20, 30 years, that is a dramatic difference in wealth by not
Absolutely.
staying invested in the markets, by not trying to time what's going on in the markets and everything else, or making really dumb decisions of, I'm going to buy the things that did extraordinarily well this last year versus, okay, what makes more sense during that current market cycle?
Yep, that's why, look, as smart as we are and we're students of the market, can't pick the tops or the bottoms. We can see when it's overextended
Yeah.
to one side or the other, but picking the top or the bottom is a fool's effort.
Yeah.
And then just looking over time, right, of all the ups and the downs, since 1926, 97 years, there's been 72 positive years, 26 negative years. So this just tells you if you stay invested, you're good. And obviously, if things are truly overextended to one side, you could always trim. You
Yeah.
don't have to get out. You could always trim. Last week, we talked about using trailing stops. Just another way to stay invested,
Yep.
but don't be a pig, right? Bulls and
Yeah.
bears make money, pigs get slaughtered. You could take some off the top and always put it in somewhere else or at another time. But this
Yeah.
is just another way of just showing facts don't lie, people. Can't, this is actually what happened. So if you just take a look at history, right? History may not repeat itself, but it does rhyme.
Yeah.
So it's important to stay invested, and it's important to be smart about when you may want to take profits and add more money to the market, but consistent contributions over time.
Yeah. Well, and I would say the other two is making sure that you're being disciplined about your asset allocation. Don't let it's easy to let things run. It was interesting. One of the positions that I've had is this stock that's in that space of artificial intelligence and all that. And I had an option position in it, and it was the discipline that I have. I the stock got to, I think, 96%, or the option got to 96%, and still looked like it had some run. And I felt, okay, it's run a lot. I'm not going to be a pig about this. I sold it a couple of weeks back, and earnings came out yesterday and it just got pummeled. So it's being sitting there and saying, okay, I've let the S&P 500 run immensely. 2021, the top one on that right side of the chart, 28%. In 2022, you should be rebalancing your portfolio to rebalance out of or take some profit off the table at those points. It's extremely important to be very disciplined about your investing, because you are going to have time periods where it will go the opposite direction on you.
And if you notice where the positive and the negative are, if you just look at the 2000s, 23 years,
Yeah.
only 6 were negative.
Yeah.
Wait,
But you also had some pretty,
you
look at 2021 up 28.48%, 2022 down negative 18%. And so if you left your just, this is the problem. I think people think, okay, I should stay invested. Yes, but you also need to make sure that you rebalance your asset allocation, because you can see, and we've seen it, I think, in recent years more and more, where we can see a dramatic reversal, and you've got to balance that thing out. You've got to pull some of that money off the table and put it into things that haven't done as well during that time period. And it's interesting. 2022, I think, is a great example of, it was hard to rebalance anything because you rebalanced into bonds, and bonds got whacked that year too, because we saw interest rates go up. So it's interesting.
Yep. Not only that, but just with the allocation, yes, you need money in the top 10 stocks in the S&P, but how far weighted are you on that side of the boat?
Yeah.
Look, you've done well in the last couple of years. Things don't go up forever. In 2019, 2020, 21, we were up double digits 3 years in a row. What made you think 2022 we were going to be up again?
Yeah.
It just doesn't happen like that. But again, people got FOMO. They don't want to be left out, and they get greedy. It's just the way it is.
Like I said, I think the biggest thing too is you've got that institutional investor, because people are just pouring money into 401k, so that money's got to go someplace.
And people have been so spoiled, Jeff,
Yes.
that a 5% pullback they think is a crash today. A 10% pullback, they think it's Armageddon.
The world is ending.
But these are normal, quote unquote.
And typically we have multiple times per year. Yeah.
Yeah. So I thought this was interesting because I was curious. And when I read it, I'm like, hey, we got to share it.
Yeah.
5% typically happens 3 times a year. How
Yep.
many times did we hear 10% is normal? Once, twice a year, it happens 10%. My point, and 15% is about every 3 years. But you would think it happens more often than that with the volatility.
Yeah.
So I just think that this is interesting. Market's at 3%. What's wrong? What's wrong with the market? Did something happen? More banks go under? What happened? It's crazy.
I think the other challenge is it's on every single channel. It always makes me laugh. One of my factors is, of course, I watch financial news every single day. Of course, it's so funny to listen for, let's say, about 4 hours straight, and you'll have 20 different opinions of these market experts during that time period. I'm sitting there this morning when I was picking up food for breakfast. I'm sitting and listening to the financial news, and there's this guy on who he's talking about the best investment over time is dividend paying stocks and everything. And I'm listening to him, and then they've talked about, what about the top 7, the Nifty 7, or the Magnificent 7, or whatever. I haven't been invested in any of them. And I'm like, so your performance has royally sucked for the last 3 years.
Yeah, it's essentially been flatline.
Yeah, flatline. And one of the guys was like, yeah, he goes, the dividend aristocrats have been up about 1% for the last 2 years. Yeah, we're about risk management and all that. Okay, risk management is one thing. You got to participate, dude. You can't just not be involved in the tech sector because it's risky. It's risky not to be in it. Inflation's going up 3% and you're turning in a 1% return. That's not good.
Now, if you're conservative, hey, have at it. Yeah. But the other thing, too, people don't realize, prior to 1980, but definitely 1970, on average, a profitable company would pay back 5 to 10% dividends. Yeah. Typically, 5 to 10% annually prior to that point. But with the advent of technology and growth stocks and biotech at post-1980 with hedge funds and private equity, a 2.5 to 3% dividend is considered good.
Yeah, the S&P average 1.72% right now for the S&P 500, the top 500 stocks in the country, and the average dividend is 1.7%, which is.
And I understand. Look, back in the day, they're like, look, we don't want to pay a dividend or pay as much of a dividend because we're still growing.
Yeah,
I get all that, but at the end of the day, they have cash war chests that are unbelievable. And I think and I think this is ironic, and we can wrap it up. The number one, the greatest investor of all time, Warren Buffett, loves profitable companies and loves companies that pay dividends. He loves that. But guess what?
His company doesn't.
His stock doesn't pay a dividend.
Yeah, I've always loved it.
I heard numbers between 150 and 200 billion sitting in cash.
Yep.
Why hasn't anybody gone to him and said, why aren't you returning some of this to your shareholders? But he looks at his performance for the last 60 years, which you can't deny. But at the end of the day, he would be returning dividends back to himself. Yeah, I've never understood that. I never heard him truly questioned and squeezed on that question. I'm not really sure why.
Yeah, it's interesting. And then he'll build up. It's interesting. I heard this statistic, and it was interesting to me. Mr. Hedge Fund, or Mr. I want dividends and all that, his largest positions outside of the companies that he owns is he does uncovered puts every single week.
Right.
That's what he does. That's where he generates income and he generates return off of that. So that's one of the areas that he uses to return better from that perspective.
And another big investors will do deep in the money calls. Yeah, that's the other thing that they do.
Yep.
So it's interesting. But that's a good one for another podcast.
Absolutely. So next week on the show, we'll do our normal market roundup, but I'm going to do a segment like Ron did a couple weeks ago on covered calls and option strategies. That's my background for 30 years. I figured I would share some of those strategies with you guys that I use and Ron uses in his client portfolios. But also, I think it's interesting if you're managing your own portfolio. We'll look to do that next week. Thank y'all for being here. As always, we appreciate it. Give us a thumbs up if you like this type of stuff, and certainly make sure that you share your comments with us, because we'd love to have a conversation with you. So thanks a lot, and we'll see you guys back here the very next time.